Did you know that 90% of millionaires built their wealth through investing? Yet most people never start because they think they need thousands of dollars? What if I told you that your first $1,000 could be the foundation of $1 million portfolio? Today, I'm breaking down the exact blueprint that financial advisors charge hundreds of dollars for, completely free. By the end of this video, you'll have a clear roadmap to turn your first $1,000 into long-term wealth, even if you've never invested a single penny before. Let's be honest, the investment world feels like an exclusive club where everyone speaks a different language. Terms like dividend yields, expense ratios, and market capitalization sound intimidating. But here's the truth that Wall Street doesn't want you to know. Successful investing isn't about being the smartest person in the room. It's about following proven principles that have worked for decades. Your first $1,000 is actually more powerful than you realize. Thanks to compound interest, money invested early has exponential growth potential. $1,000 invested at age 25, earning an average return of 7%, becomes over $21,000 by age 65. That same $1,000 invested at age 35 only grows to about $10,000. Time is your greatest asset, and starting today gives you an enormous advantage. Before we dive into where to put your money, we need to establish the foundation. Think of this as building a house. You wouldn't start with the roof, right? Your financial foundation has 3 critical layers that must be in place before investing a single dollar. Layer 1 is your emergency fund. I know this sounds boring compared to picking stocks, but hear me out. Without an emergency fund, you'll be forced to sell investments at the worst possible times. Aim for at least $1,000 in a high-yield savings account. This money isn't for investing. It's your safety net that protects your investments. Layer 2 involves eliminating high-interest debt. If you're carrying credit card debt at 18% interest, paying that off guarantees an 18% return. No investment strategy can consistently beat those odds. Tackle credit cards, personal loans, and any debt above 7% interest before investing. Layer 3 is understanding your timeline. This $1,000 should be money you won't need for at least 5 years, preferably 10 or more. The stock market has ups and downs in the short term, but historically rewards patient investors over longer periods. Now comes the exciting part: where to actually invest your money. The investment landscape offers countless options, but for your first $1,000, simplicity beats complexity every single time. Let me introduce you to the 3-bucket approach that removes guesswork and maximizes your chances of success. Bucket 1 is index funds, which should represent the majority of your investment. Think of index funds as buying a tiny piece of hundreds or thousands of companies at once. Instead of trying to pick the next Apple or Google, you're betting on the entire economy's growth. The S&P 500 index fund tracks America's 500 largest companies and has averaged about 10% annual returns over the past century. For your first $1,000, consider putting $600 into a total stock market index fund. This gives you exposure to virtually every publicly traded company in America. Popular options include funds with ticker symbols like VTI or ITOT. These funds have incredibly low fees, usually under 0.1% annually, meaning more money stays invested and working for you. Bucket 2 adds international diversification with $200. While America's stock market has performed exceptionally well, other countries sometimes outperform. International index funds expose you to companies in Europe, Asia, and emerging markets. This diversification reduces risk because when one region struggles, others might thrive. Bucket 3 allocates the remaining $200 to bonds through a bond index fund. Bonds are essentially loans to governments or corporations that pay steady interest. They're generally safer than stocks, but offer lower returns. Young investors often skip bonds, but they provide stability during market turbulence and generate income. This allocation gives you roughly 70% stocks and 30% bonds, a balanced approach perfect for beginners. As you get older or more conservative, you can adjust these percentages, but this starting point has served millions of investors well. The next crucial decision is choosing the right account type. This choice affects how much you keep versus how much goes to taxes. For most people, a Roth IRA represents the best starting point for long. The next crucial decision is choosing the right account type. This choice affects how much you keep versus how much goes to taxes. For most people, a Roth IRA represents the best starting point for long-term investing. With a Roth IRA, you invest money that's already been taxed, but all future growth comes out completely tax-free in retirement. Imagine your $1,000 growing to $50,000 over 30 years. In a regular taxable account, you'd owe taxes on that $49,000 gain. In a Roth IRA, it's all yours. The annual Roth IRA contribution limit is currently $6,000, so your first $1,000 fits comfortably within this limit. You can open a Roth IRA at virtually any major brokerage firm, many offering zero commission trading and no account minimums. If your employer offers a 401k with matching contributions, that changes everything. Employer matching is free money, representing an immediate 100% return on your investment. If your company matches up to 3% of your salary, contribute at least 3% to capture the full match before funding your Roth IRA. Let's address the elephant in the room. When should you actually invest this money? Market timing is the biggest mistake new investors make. Trying to predict short-term market movements is nearly impossible, even for professionals. The best time to invest was yesterday. The second best time is today. Dollar cost averaging offers a smarter approach for nervous beginners. Instead of investing your entire $1,000 at once, invest smaller amounts regularly over several months. This strategy reduces the impact of market volatility and removes the pressure of timing the market perfectly. Consider investing $250 per week for 4 weeks, or even $100 monthly for 10 months. This approach builds good habits while reducing the emotional stress of watching daily market fluctuations. Here's what happens after you invest. Absolutely nothing exciting for a while. Successful investing is boring. Your account balance will fluctuate daily, sometimes dramatically. During market downturns, you might see your $1,000 drop to $800 or even $700. This is completely normal and expected. The key is developing the right mindset from day one. View market declines as sales, opportunities to buy more shares at lower prices. When stocks go down, your future investments purchase more shares for the same dollar amount. This concept, called buying the dip, is how wealth builders think differently than average investors. Avoid checking your account balance obsessively. Successful investors often check their portfolios monthly or even quarterly, not daily. The constant noise of financial media and market updates creates anxiety that leads to poor decisions. Your investment journey doesn't end with this first $1,000. The real magic happens when investing becomes a habit. Set up automatic monthly transfers from your checking account to your investment account. Even $50 monthly compounds significantly over decades. As your income grows, increase your investment amounts proportionally. Many successful investors follow the pay-yourself-first principle, treating investments like a non-negotiable bill that gets paid before discretionary spending. Review and rebalance your portfolio annually. As different investments grow at different rates, your original allocation might drift. Rebalancing involves selling portions of overperforming investments and buying more of underperforming ones, essentially forcing yourself to sell high and buy low. Remember that investing is a marathon, not a sprint. The strategies outlined today have created more millionaires than any get-rich-quick scheme ever will. Your first $1,000 represents the beginning of something much larger, a lifetime of building wealth through disciplined, consistent investing. The most successful investors started exactly where you are right now, with limited knowledge and modest amounts of money. What separated them wasn't superior intelligence or market timing ability. It was the courage to start and the discipline to continue. Your financial future begins with this first step. Take action today because your future self will thank you for the courage you show right now.